Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast. I'm your host, Christian Allen, with my co-host and business partner, who we all know as Rod the Pod Zabriskie. Rod, what's going on, man?
Hey, I am doing great. Fall is a wonderful time of year, not only because of the stuff I always talk about, but we actually have one of our son, Jefferson, was living in Brazil for a couple of years, and he's home now.
All right.
Going to school
Congrats.
at Utah State.
That's exciting.
Yeah,
All
it's
right.
fun to have him home.
Rod, should I start introing myself as Christian the Answer Allen, since that's what we've given, or that's the best nickname I've been given up to this point?
Yeah, that I think we
How
should.
do you think that would play off?
Or I should.
Okay,
should.
you're gonna, because it's never good to call yourself a nickname. Like that's just
especially when
typically a bad
the
idea.
answer. I mean, it's fitting.
Yeah,
but
that's pretty rough. Okay, you're right. I'm not gonna intro that way. But a shout out to one of our clients and listeners who was kind enough to come up with the best nickname so far.
sticking.
Hey,
It's gonna stick.
okay. So today, Rod, we're talking about the two financial playbooks that every investor must, or I should say, every high income earner, but every investor, it doesn't matter, has to choose between or must choose between. Now, what does that mean? A little bit of context here. I've talked about this on the pod before. Rod and I, we play in a little bit of a obscure space in the financial world, right? Because you've got on one side, you've got the traditional advisors, and then you've got the alternative side. And the problem is that those two don't like to cross over very well. So for us, we are financial educators who actually want to use both the traditional and the alternative space, but our primary revenue source is insurance. Okay, so it's a little bit unique in that space, right? And the reason is if we suddenly wanted to, well, okay, so let's say that I was still securities licensed. If I was still securities licensed, Rod, I couldn't talk about alternatives anymore. So we couldn't even give the playbook that
true.
we actually believe in. So
Yeah.
we had to, we had no choice but to separate from that kind of like linear traditional thinking. And yet, even when you go into the alternative space, it's still a little bit of okay, what's my point? Well, a lot of times people ask me what I do for a living, right? Obviously, I'm talking about people who I see on the street. Like I'm building a house, and I feel like lately I've got this question a lot. I go meet with like contractors or people who own, different companies, and they're frequently like, "Well, what do you do?" And I notice that I'm, as much of a presence as we have and as much content as we put out there, I was having a difficult time answering it. So I did what Christian does best is I go to the real answer, which is Jarvis, aka ChatGPT. Uh, and I started to have a dialogue and figure this out. So I'm really excited, Rod, because we're going to talk about a way. Here's what this does: it really answers what we do and how we do it, and that's gonna be what we talk about. So back to our two playbooks. There's two playbooks that investors have to choose from. The playbook number one is what we're going to call the Middle America playbook. Playbook number two is what we're going to call the Wealthy Family playbook, aka the Money Insights, Money Insights Wealth Building playbook / Invest with Benefits philosophy. That's the primary contrast. Okay, so now that we've gotten that far, Rod, I want to start by talking about the Middle America playbook, and we're going to dissect the challenges, the problems that exist within it. And ultimately, what we're going to get to is helping people understand the difference between the Middle America playbook, the Wealthy Family playbook, and we want them to know what? We want them to know that we teach people the Wealthy Family playbook. So at the end of the day, this whole episode came about because I was trying to help myself figure out how to answer the question, what do we do? Well, we teach people the Wealthy Family playbook and we help them execute on it. Okay, so Rod, question for you: what is the Middle America playbook? Let's dissect it.
Yeah. So the Middle America Playbook, the Middle America Playbook is, well, you could probably ask just about anybody on the street, what does it mean to invest, right? Well, what are you doing to invest? And they would give the answer that I'm just about to give, and that is, you get a steady job somewhere where you can contribute to a 401k. Hopefully they help match that up. You're building up a chunk of money that's going to allow you to retire someday. And what will determine whether you can retire or not is if you've built up enough money that'll last the rest of your life without running out. Right?
Yeah.
That's the
Yeah.
Middle America Playbook.
Okay. Okay. So, but we got to unpack this because you went through a lot. What I heard you say is number one, we're talking about a market centric approach. Stocks, bonds,
Yes,
mutual funds is going to
very
be
much
our
so.
primary driver. You talked about a lot of money going into IRAs, qualified plans, right? We get a job, we put money into our 401k. It's just on autopilot.
Yep.
And we talked about that element. And Rod, you talked about the entire methodology, which we often discuss, and that is accumulation versus cash flow.
Mm-hmm.
And there's huge problems with all of them. We haven't even gotten into tax issues. So let's unpack those first few things and talk about maybe why it's a problem to take a market centric approach. And I want to say this. I should almost say it like this, a market only approach.
Yeah.
Because I
That's a good point.
actually, for some people, I'm comfortable with them using a market centric approach. The problem is when people are doing it without understanding what else is out there, they're making choices based on ignorance, unfortunately.
Mm-hmm.
And I don't mean that rudely, just meaning that it hasn't come into their world at that point. They're making choices based on that information when they really need the full picture in order to determine the playbook that actually works best for them. There are situations where some people probably should and feel more comfortable sticking with the traditional playbook, and that's where they're going to go. And that's great, right? I actually am not here to tell people which one is right and wrong necessarily. We are going to talk about and break down the good, the pros, and the cons with both. But at the end of the day, we're teaching basically what we believe to be an accelerated version of that middle America playbook, a way that we can create the financial independence that we're looking for much earlier than we would in that kind of slow grind where we start working at 25 and we plan to go till it keeps creeping up 67, 68 now,
Yeah.
whatever it is, right? That's
Yeah.
the old playbook. People don't like it. So anyway, there's a lot of them. Which of those elements do you want to start with?
Well, let's start with the market. So if it's market only, there are a lot of problems with that. And even if, because, right, you're told have a well-diversified portfolio. And if you're getting into ETFs and mutual funds, that's how you're getting it, right? Because in that mutual fund, they're already spreading you across a bunch of different companies, different stocks, bonds, whatever, right? So you're told you're diversified. However, when the market is dropping, you're dropping, right? You're not immune to the volatility of the market, right? So problem number one is, how do I time my retirement? Well, they would say, well, get out of stocks, right? The closer you get to retirement, then you want to have fewer stocks, less volatility, put more into bonds because that's going to be more predictable.
I've got
Oh,
a
that's
great
great.
scientific rule to help with this, Rod. This is a
Yes.
scientific rule. It works every time without fail. All you have to do is create a balanced portfolio between stocks and bonds and tie it directly to your age. Easy peasy, scientific. So
Yep.
I know that when I'm 70 years old, that means 70% of my stuff's got to be in bonds at this point. Simple, Rod. I've got a solution. No, I say that obviously sarcastically. It's a silly, ridiculous rule, right? But sadly, it still is in existence today. People still use it. It's almost as bad as the 4% rule. Not quite, but almost.
Yeah, and it becomes challenging because the reason why they suggest you do that is because if you're subject to the volatility of the market, then you're in real trouble if you're trying to live off of that money and that's all you've got, right? That whatever you saved up and got to that 68, whatever it is, and decided to retire, that's it. If the market loses value and you're taking money out of that account, then it's going to be harder for you to recover when the market has lost, right?
So yeah, so it's basically the traditional world's attempt to plan for sequence of returns risk or
Hmm.
the timing risk of when we actually retire.
Yes. But then the problem with that is, let me ask you this. On average, over the last 50 years, would the 70% bond portfolio perform or get you as high of a return as the average 70% stock portfolio?
Hard no.
Of
Everybody
course not.
knows that the
Yeah, of course
long-term
not.
returns are better in equities than they are in debt. It's just the way it
Yeah.
is.
So you're giving up return in order to get the safety, and yet the return is what's more likely to help your money last longer if you live a long time, right?
Yep. Yep.
It's
I have seen those contrarian, like traditional contrarian who are like, you know what? They actually see this point and will
mhm.
say, we just need to go aggressive all the way through. Just all the way through, because at the end of the
Yeah.
day, that will actually create a better result. And to be totally honest with you, based on the result, I agree with them. Except that we still have this massive problem, and that is the situations where, 2008 comes in and
Yep.
somebody
Timing.
loses a massive amount of their money or just even a big chunk, and suddenly it upends their entire life's trajectory goals, right?
Yeah.
Suddenly, instead of retiring at 62, now they're like, well, I got to work till 70. Like, just think about the difference that can make in somebody's life. I think about it, and I'm like, that could be the difference between somebody getting 5, 6, 7 years to go and travel the world, and maybe they have to put that off, and then they don't have the same health that they did before, and it becomes totally unrealistic to do some of that. So,
Yeah,
so yeah,
that's a
there's
great
some real
segue
problems with it.
into the second problem that I see, and that is just this is from experience of watching people go into retirement. They had all these hopes and dreams and plans of what they were going to do, and then they don't dare. When they get there, because of what we talked about in kind of problem number one, which the result of problem number one is either more volatility than they're comfortable with, or they went all, made a huge shift over to safety, and so they're not going to have much of a return. And that makes them concerned. Well, if I do go out and take the trips and spend the money, what if, right? What if I run
Yep.
out? And
Am I
so,
going to run out of
they
money so I
don't.
can't spend money?
They don't. It's a
Yeah,
problem.
it is a problem. So either way, even if you've saved enough, you're often ending up in a difficult situation where you don't even dare to spend your money for fear of the possibility of running out, right? Yeah, and I think it's a huge problem because again, if people are at the stage of life where they're supposed to be enjoying their money and instead they're hoarding it, like again, that's just not the way that we want this thing to go. So
Yep.
there's got to be things that we can do to get better. Okay, but we're not here to create solutions quite yet. We're going to focus on the problems first. So we've talked about the problem with just things being totally market centric. You talked about uh, the problem of retirees getting to a place where they could spend their money and just not even being comfortable or daring to do it. What are some of the other issues that we run into inside of the middle America playbook?
If I'm primarily relying on traditional retirement accounts and I put all that money into the account tax deferred, now when I'm in retirement and I'm living off that money, every single dollar that I take out, that's my own money, all of that money is going to be taxable.
And this ties in perfectly with the point you just made. That's another reason that we see people not wanting to spend their own money,
Yeah.
right? Because
Yeah.
they're like, well, I could run out. Even when I take it out, I get taxed like crazy. And so for
Hmm.
those reasons, people just end up hoarding it. And that's why we have this, like, or at least that's a part of why we have this, this generation where there's going to be a huge passing of money from the baby boomers down to the millennials. So it's just an interesting dynamic. Okay, so market centric, tax inefficient. What else we got?
It depletes the assets.
Depletes.
So
Okay, that's a
it
massive problem. That's a massive problem. Okay, so you're talking about accumulation methodology here. This
yes,
is critical.
spend down.
So let's
Yeah.
talk about why that methodology is problematic for people.
Well, it creates the problems we've talked about already, the fear of running out of money. And for somebody who is legacy minded, wants to pass money on to the next generation, they're also concerned about that, right? And because the asset by itself is not efficient in passing on for the reasons we already mentioned, market-based, but also the tax part of it. Let's say that I'm afraid to spend. I end up with still a bit of an asset to pass on to my kids, but it's all inside of a retirement account. Well, when I do that, it becomes all taxable pretty much right away, right? It used to be that we could spread it out for longer periods of time, but they've changed the rules so that I can't do that as much anymore, right? So now all of a sudden my kids, they inherit this money that is taxable income to them, and all of a sudden more of it was going to taxes than I was afraid of when I was alive and not spending it.
Yeah. So I don't know where this methodology came from. I probably should do some more research. I'm sure we could figure it out, but for some reason, we got into this place where we just feel like I can build up this pile of money and then I'll just figure it out from there. And that is typically what people are doing. But to your point, if I do that, I end up with a very real possibility of actually spending down the asset so that I don't have what I actually. So here's another problem, Rod. From an actual cash flow or return perspective, it's horribly inefficient, right? So we've done the math on this. Like if I'm going off of the 4% rule, because that's really the safe, like the 4% withdrawal rule, I won't say it's safe, but even if we use that as the safe withdrawal rate, as the consistent safe withdrawal rate, it's incredibly inefficient. The amount of money I have to create inside of my accumulated funds in order to create an income that works for me is crazy. So I think of it this way: if I'm going to be creating we'll just do simple math, a $400,000 income, I've got to have I've got to have $10 million worth of assets accumulated in cash that could be spent down. Like, and the reality is that's very difficult to do. Do you know what I mean? If you counter that with some of the things we're going to talk about, it's very different to where, we show examples where you can get a 12 to 15% payout rate over a long, long period of time. You
And you're
compare
not
that
depleting the
kind of an
asset.
ask and not depleting the asset. So you compare that with the possibility of the market asset being depleted, and it ends up just kind of becoming something that's more clear and easy to see the problems with. Let's just do a quick recap. We've talked about the market issue. We've talked about taxation, and when I say that, we've talked about it in the sense that like the traditional playbook focuses on tax deferral, but another way to focus on the tax element is just that investing in the traditional world doesn't carry a lot of tax advantages with us.
Right.
The only tax advantage is primarily the tax deferral, and we can make a
If
really serious argument as to whether that's actually going to be a tax benefit. So that's a really critical difference, and we'll jump into that as we get into the wealthy family playbook in a second. So market centric, we've talked about taxes, we've talked about the accumulation methodology being problematic and potential for running out of money. I think that pretty well covers it. If we think of anything along the way, we'll hit it back. But let's now counter this, Rod, and start talking a little bit about what the wealthy family playbook looks like and how it's different and why it's different. Like, what was the purpose for even needing to create a different playbook?
I mean, I guess the answer to that is all the problems with the
I guess
accumulation
so.
one, right? But it just is clear the difference, right? And let's characterize. So if we're calling the first one the Middle America playbook the accumulation method, we're going to call the wealthy family playbook the cash flow method. And it's a fundamental shift. Instead of me being focused primarily on growing the pile of money that I can then spend down over the rest of my life and hope I don't run out, instead I'm creating cash flow. So I have assets out there that are flowing cash off of them that create streams of income to replace the income that I was living off of when I was working. So, well, we've hinted on this. The first thing is I'm not worried about depleting the asset, right? I'm thinking about just creating predictable streams of income, right?
And we should say this, like the income can come from anywhere. So when we say cash flow and we're countering it with the accumulation methodology, that doesn't mean that every investment that we're looking at has to be a cash flow play, right?
Hmm.
We're just
Hmm.
saying that as a whole, instead of building a pile of money to spend it down, we're building assets which spit off cash flow consistently. And
Yep.
that's the fundamental difference that we're really trying to hone in on. Okay, so going back to the what does money insights do? That question that I was continue that I get asked frequently. Well, I felt like I needed to create something that helped people see exactly what we do in just a moment's notice. And so this is what I came up with, Rod. And I think it does it. You'll have to
Yeah.
tell me what you think, but I think it does it. So we've again talked about all of the problems that exist within the traditional world. We're not going to continue to run down that road. Now we're going to get locked in on what are the benefits that exist inside of this wealthy family playbook or the cash flow methodology. The first thing is that it's just, to your point, fundamentally different. The mindset is different. And let's talk about how some of those ways or some of the specific ways that are different. The biggest one is that in the cash flow methodology, people are typically thinking about growing generational wealth, right? It's about like, there's never any intention to start spending down my money. The intention is always to build, right?
Yep.
So if you look at just that difference alone, one is hoard some money so I can spend it down, or build money. I don't want to say build up money so that I can spend it down. The other is build up assets so that it can support my lifestyle and then I can pass on to the next generation. So that's a massive, massive difference. And then to start, Rod, you can see if you look at the infographic, there is a big, big difference on that outer ring. I'm going to start with the outer ring because if you think about it, when we were talking about the Middle America playbook, it consisted of public markets.
Hmm.
What else? Like seriously, what else? Like maybe some annuities that get thrown in there in the traditional space a little bit, but nobody's talking
Maybe.
about alternatives,
Yeah.
right? And so here on this screen, we're talking about totally different things. We're talking about private equity, private credit. Um, we're talking about business ownership, right? All of these things, real estate obviously is a huge one, cryptocurrency, all of those things fit into a more holistic way to invest that's just more powerful, creates greater acceleration, has a more optimal impact on your bottom line and what you're actually looking to accomplish. And why do we know this? Man, because we met with so many people for so long that we've just like seen this play out over and over and over. But anyway, one of those things that comes to my mind is just there is a huge difference in the what I actually invest in as a starting
Yeah.
point. What are some of the differences that come to your mind, Rod?
Yeah. Well, on that same point, we hounded on this idea of only investing in the market and the reason that's a problem. Well, one of the things I pointed out was even though you're told that you're diversified inside of the market, if the market's going down, you're going down, right?
Yep.
Here, you have a diversification across a whole different markets, different risk classes, different risk profiles, so that even if the value of one area is going down, that doesn't necessarily mean everything else is going down. And not only that, when you look at it from the standpoint of the cash flow side, let's take real estate as an example. 2008, right? In 2008, I could have my portfolio of real estate investments and the value of those properties went down, but did my rents go down? Did my cash flow go down? Not likely. There were a lot more people renting after that than there were before the crash, right? So chances are, like in terms of just supply and demand, that rents likely went up for me after that happened. Even though the value of the property themselves went down, I was strong and if not increasing on the cash flow side. So that I think makes a huge difference compared to what we were talking about as if I'm only in public markets.
Yeah, I think that's a great point. So one of the just like stark comparison differences is what we're actually investing in. But if we take that a level deeper, there is a real critical and a critical difference in the actual principles, the wealth building principles that we're following. So again, I'm trying to think of what those wealth building principles, if I was to like hone in on them on the traditional side, like it again, we talked about it being built on an accumulation model. Maybe you could say it's built on the idea that of compound interest. I don't even know what else you would kind of, you know what I mean? Tax
You tax
deferral.
deferral. Yeah,
Those are the
exactly.
things that I would kind of look at. And so if you juxtapose those against the principles that we believe in at our core, you'll see a big difference. Okay, so things that we talk about, our 6 core benefits. Leverage. Leverage is a huge one, man. If you don't ever use leverage, there's no way to accelerate your wealth anywhere near to the extent of the person who learns how to effectively do it. Like there's just no
And
way around it. People who learn how to effectively use leverage are always going to grow wealth more effectively than people who don't. Period. End of
and
story.
often we get people countering us and saying, "Well, you can use leverage in public markets."
Mm,
And while that's true that you
kind
can,
of.
does middle America do that? No.
And
They're
that's
putting
a
the money in
really
the
good point. Like,
401k, they're just letting it sit there.
yep. And here's the thing, even in a 401k, okay, so we have a 401k through some of the insurance companies, that kind of thing. They'll offer some of these extra things for us. And so we have a 401k, and I was looking at some of the rules and regulations behind it. And I can, turns out I can loan against that. But guess how
Yep.
much I can loan, Rod?
Let me guess, 50?
50K. That's my
Yep.
number. That's it. End of story. I can't. So that's like a very small portion of the overall account value, right? So
Yep.
like to your point, yes, there are places where in the middle America playbook, people could use leverage, but the problem is that leverage isn't emphasized. So
No.
because of that, people just aren't using leverage typically, right? Normally people who are more sophisticated are going into margin type accounts and things like that. And
Mhm,
even
mhm.
then, there's obviously a very big difference in that kind of leverage versus leveraging money from a bank to buy a piece of real estate. They're just different mechanics that exist inside of that.
Yeah.
The underlying principle still the same, but there's still underlying like tax advantages is a huge problem. Okay, velocity. We always talk about keeping our money in motion. Tax optimization is a huge one. This is one again. They basically forget in the Middle America playbook outside of tax deferral. So, which it's hard to even definitively call tax deferral a tax benefit because we just don't know. And I would argue that for most high income earners, it's pretty clear that it's more likely to be a tax drag than a tax benefit. Right?
Do you know
If
how
we take a step back and take the logic, what were you gonna say, Rod?
Yeah, well, do you know how we know this? People, cheer every time a Roth option is added, right? People
Yes.
people see this, and okay, so, yeah, as far as the logic goes, if I'm in the same tax bracket when I set that money aside as I am when I take the money out later, there was no advantage to me from a tax standpoint. Some people think there is
Zero.
because they think, "Well, if I put it away tax-free or pre-tax, and then I have more money there that's growing." And that's great. Well, you grew to a bigger number, but then when you take the money out, if the tax rate is the same, then you're paying higher taxes as well. You end up at the same net number of actual spendable money after the tax got taken care of, right? Also, then on the flip side, okay, well, if it's a Roth, I'll pay the tax today and just accept, okay, I know what it is today, and then we'll see what happens later. In that case, I'm betting or hoping taxes go up and I'll feel better having paid the tax today versus paying it later. But either way, I'm taking my chances, right? I'm
Well, and
making a bet.
again, I would just argue that even if you're a reasonably good saver, because the numbers aren't that high, it's not like you have to get to $1 million before you start paying high tax rates, right?
Mhm, mhm.
So you can be a moderately good saver as a high income earner and turn into a place where you're creating a $250,000 income, and it could be completely taxable, right?
Yep,
And so if I look at that, then the chances are, and if I'm in that higher tax bracket, I would likely be better off by not getting into bed with the IRS at all if I can avoid it and having more control. And of course, one of the benefits of a lot of the things we talk about, a lot of things that we invest in, is that I can actually get very real tax benefits that are existing today, like
yes.
real tangible benefits. And when I say that, I'm talking about an actual reduction in what I would pay in taxes, nothing to do, not just a tax deferral. Tax
Yep,
deferral has its place in situations, but if your whole identity is based on that, you're going to end up in retirement scratching your head and thinking like, gosh, I wish I would have done this differently. Like we've
yep,
seen it way too many times.
yep.
Okay, so we've talked about tax optimization, asset protection, estate planning, all of these. I think I missed one of them in there, Rod, but
Well, cash flow, because that's what we've been
cash
emphasizing
flow.
all along.
Yes,
Yep.
that's
Yep.
right, cash flow. So anyway, but the point here is that it's really a principled based approach where we take these again, core principles that we know work, that have a history of building real wealth, not just again, not just at a like we're talking real wealth. We're using the same playbook that we've seen wealthy families for generations and generations do so well with,
Mhm.
and now we're just putting it into use. But again, people don't always realize that it is principle based. It's not based on, hey, they just invest in here, they just invest here, they
Mhm.
just invest there. It's really a principle and intention based approach. Okay, so now, Rod, we get to the center ring. And I'm going to pose the question to you. Why do we start, or why at the center of this whole model is there an opportunity fund? What comes to your mind when I ask that question?
Yeah, because the money that's moving into, well, let's say through these principles and then into the assets on the outer ring, I need to have a core place where I'm flowing that money in and out, right?
Yeah, and there's a
And
lot of inefficiencies with the
right,
places
depending on
that
what I
people
choose.
typically put money in.
Yep, exactly. So it matters. It makes a huge difference what I use as my opportunity fund as I'm investing and doing this kind of wealthy
Okay, so let's
family
play this
playbook.
out. So in my mind, an opportunity fund suggests that I'm looking to be opportunistic. I'm looking
Mhm.
for opportunities to go and invest my money and create real returns. It could look a lot of different ways, right? It could be a business opportunity. It could be a hands-off investment opportunity. But here's the problem: if all of my money is stuck in a 401k or IRA, it doesn't matter what those opportunities are because it's going to be really difficult for me to take advantage of them anyway. So the
Yep.
opportunity fund sits at the middle because that's where we can create acceleration into our and we can take advantage of the opportunities that are coming across our desk. Whereas again, inside of this middle America model, there's just not a place for that because
No.
automatically our extra money's going into either our emergency fund or our 401k. Well, where does that leave us when we want to start investing and creating cool opportunities? And again, investing in real estate, investing in deals, or just investing in ourselves, investing in our education, investing in our own business. These are far and away the biggest wealth creators. And these are the exact things that the middle America model is just ignoring altogether.
Yep, for sure. And so number one's not even on the radar, but like you said, even if someone kind of catches a glimpse, oh, hey, maybe I do want to go do this over here. Well, too bad, your money's all locked up.
Yep, stuck. Don't plan on it. Okay, so Rod, we've hit. Did we hit on the fly? Like, did we miss anything as it relates to the wealthy family playbook? Here's the good news: it's not that complicated, right?
Mhm.
Like when you see it in a screenshot like this, it's like, oh, these sound. Now, maybe if you're not as familiar with different opportunities within the private equity and private debt world, like maybe those are a little bit obscure still. But all I have to do is take these principles and then go learn that next step. And the next step is the investments on the outer ring. And we put 8 examples. We could probably put a bunch of other ones
For sure.
here too. But the reality is we have this open playbook of opportunities that we want to take advantage of. And in order to do that, that center ring or the foundation has to be an opportunity fund. Okay, before we call it for today, there's some really important elements that have to exist within this opportunity fund. So, full disclosure, anybody who's listening to this probably knows we love and use high cash value life insurance as the opportunity fund. Why? Because it carries the characteristics that we can't find, at least up till this point. No other asset class carries those same characteristics. And what we're talking about is things like the underlying safety that I get from a whole life company that's been producing dividends for 180 years. So I know when I put my money into the policy, it's going to grow at 5 to 6%, regardless of how interest rates, go, whatever direction they go. We've seen that, by the way. Regardless of what the market's doing, I just have that consistency note. Now, let's be really clear. That alone is not going to create the wealth that we want to, right? That's the holding place. That's the opportunity fund. But again, it has to be growing for us, has to be doing something for us in the interim. Otherwise, we're losing, we're potentially losing value due to inflation, for example. So we've got to be keeping, but it has to have other things too. It has to be liquid, right? We've talked about that. I can't suddenly pull from my 401k. Maybe I can pull a little bit, but probably not everything I need to. And even then, it's not doing one of the main things. I'm not creating value in two places at once, which we'll talk about in just a second. Okay, so it has to be liquid. We need, or I shouldn't say we need tax advantages, but we certainly want them,
Yeah.
right? And so again, if you're comparing to like now your checking or savings or CDs, well, I can get a little bit of interest there, and it can be safe and liquid. So it checks a few of those boxes, but it's missing the tax advantage and probably the return profile,
Yeah.
right? So all of these things. Okay, what's the point? The reason that we use high cash value life insurance as the opportunity fund is because it has all these characteristics. Plus, by the way, it has a death benefit and long-term care benefit. And so it ends up being one of those things that can be multi-purpose in a really meaningful, really powerful, impactful way. So for those reasons, Rod, those are the reasons that we end up using high cash value life insurance as the opportunity fund. But I want to make something really, really clear. And that is that the playbook is not built on the life insurance at all. It's built on the principles. So I could absolutely use this exact same framework and I would do extremely well, regardless of whether I was using high cash value life insurance as my opportunity fund. What that does is it creates the optimum experience, right? It
Yeah.
boosts our returns in a way that we couldn't get otherwise. It creates death benefit and other benefits that I couldn't get otherwise. So it just ends up being one of those things that makes sense. But again, it's not about the product. It's really about the principles that make up good strategic generational wealth building. And the thing that we want to emphasize is that you really do have a choice, right? And people have a choice. They can choose to go all in on the traditional model. And we've seen it over and over. Typically, those people aren't getting to where they want to go. And we have all sorts of social proof to suggest that that's true. And then on the other hand, we've got this path that really does lead to greater acceleration and greater opportunity. By the way, it's a whole lot more fun. So
Hmm.
for all of those reasons, that's what makes sense to us. So anyway, going back to our core question, well, we teach the Wealthy Family Playbook, and we really hope that people, as they're listening to us and as they interact with our content, that it's less about the product, more about the principles, focused really on the education that allows us to get to that place that we want to go. Anyway, those are kind of my concluding thoughts, Rod. I know I've been all over the place. Do you have any thoughts before we close up shop for today?
Just that, believe it or not, we are continuing to develop new educational opportunities for you to learn. So clearly the podcast has been built on that. We're now 4 years strong doing this, and we'll continue. We've been doing a couple of different webinar series.
Yes.
We've been doing a couple of webinar series. We have a course that we're putting together. Anyway, we will continue to develop because it's just hard to ignore it. There is not as much information out there as it relates to this Wealthy Family Playbook as there is the Middle America Playbook. And we're on a quest to change that. We want people to be able to go to places where they can learn and really understand why, like the reasons behind, learn the principles, go out and do it, make it happen, because there's just a huge difference between the two. You just can't ignore it.
I love it. Okay. Closing thoughts then. Make sure, or this is more of my CTA, make sure to go join the community, the Facebook group, Investment Strategies for High Income Earners. We've got a great and growing community. That's also the place where you'll get all of the Investment Insider Series webinar replays. So if you want to look back and see who we've had on, we're going to have a lot of good guests coming on with a lot of great opportunities. And again, to Rod's point, it's about creating education and opportunity so that you guys can go out and create what it is that you want to create. Thanks everybody for listening, and we'll see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.